Yesterday we discussed about what is the meaning of financial planning and how it differs from financial planning. Today we are going to see a very important aspect of financial management, that is capital structure. Now you all are aware what is capital structure, that is debt equity ratio, or the proportion of owners and borrowed funds is known as capital structure. Now, how much debt should be there and how much equity should be there, that is an important decision, because both the sources of finance, they differ in the respect of cost and cost and risk. You know that debt is less costly but more risky because the company has to pay the interest and repayment is obligatory, and the cost of equity is more but it is less risky because the company has to pay the dividend only in the years of profits, not in the years of loss. So debt is cheaper because tax deductibility is also there when they are calculating the interest. That means interest is tax deductible expense, but dividends are not tax deductible expense. So debt is cheaper, but it is more risky for a business because the payment of interest and return of principal is obligatory. Any default in meeting these commitments may force the business to go into liquidation. But there is no such compulsion in case of equity. Therefore, it is considered as riskless. Higher use of debt will increase the fixed financial charges of a business. As a result, increased use of debt increases the financial risk of a company. But here we are going to see that what is the optimal capital structure of a company, because the capital structure affects both profitability and financial risk. So a capital structure will be optimal when the proportion of debt and equity is such that it results in increase of value of equity share. That means all decision relating to capital structure should emphasize on increasing the shareholders' wealth. Now let us see this concept of financial leverage or trading on equity with this example. The company X Limited has the total funds or investment or funds used is rupees 30 lakh. The interest on debenture is 10% per annum. The tax rate which will be calculated for dividend or the income will be 30%. EBIT, that is earning before interest and tax, is rupees 4 lakh rupees. Now we are taking three situations. Situation number 1, where there is no use of debt, only equity is the source of finance. Situation number 2, when 10 lakh rupees is funded by the debt. And situation 3, where 20 lakh rupees is funded or financed by the debt. Now we will see what is Ebit Eps Analysis. Ebit is earning before interest and tax. EPS is earning per share. This is for the shareholders. Earning per share is for the shareholders. So this analysis when we will do in situation 1, we see that 4 lakh is given as the EBIT. So 4 lakh is there in all the three situations as the earning before interest and tax. Now interest calculation will be nil in the first case because here we have not used any debt. In the second case we are using 10 lakh rupees debt. That means 10% of 10 lakh is 1 lakh. So that much interest to be paid to the debt holders. In the third situation, 20 lakh debentures or 20 lakh debt is there. So 10% on 20 lakh will be 2 lakh. So the interest payment will be 2 lakh in the third situation. Now after paying the interest, what is earning? That means earning before tax but after payment of interest. So we will just deduct nil from 4 lakh, that is 4 lakh. Then 1 lakh will be deducted from 4 lakh, that is 3 lakhs. Then 2 lakhs deducted from 4 lakh, that is 2 lakh. I think this much is clear for you. Then we will see what is the calculation of tax. So calculation of tax in the first case, 30% of 4 lakh will be 1,20,000. Now here 30% of 3 lakh will be 90,000. 30% of 2 lakh will be 60,000. So the tax payment will be this much. Okay. Then earning after tax, after payment of tax, then we will deduct again 1,20,000 will be deducted from 4 lakh. So it comes to 2,80,000. Here 90,000 will be deducted from 3 lakh. So it comes out to be 2,10,000. Then here 60,000 is deducted from 2 lakh. So it comes out to be 1,40,000. Now let us see next step, that number of shares of rupees 10. So in the first case, the complete funding is done by the equity. So the shares are of 3 lakh. Okay, that means 3 lakh shares are there because 30 lakh is the investment or the total funds used. So the total funds used is 30 lakh. So 3 lakh shares of 10 rupees each are used here. Here 10 lakh are from debt. That means out of 30 lakh, 10 lakh are from debt. So what is remaining is 20 lakh. So 20 lakh means 2 lakh shares of 10 rupees each. In this case, similarly, 1 lakh shares of 10 rupees each, because here 20 lakh has been funded by the debt. Now let us see EPS, earning per share. Now this we have to divide this by this, because this is the earning and this is the number of share. Earning divided by number of share. So when we divide 2,80,000 by 3 lakh, we get 0.93. When we divide 2,10,000 by 2 lakh, we get this much, that is 1.05. Then when we divide 1,40,000 by 1 lakh, then we get the result as 1.40. So you can see that earning per share is increasing as we increase the amount of debt in the capital structure. Now how this is happening? Here the concept of ROI. ROI means return on investment. That is earning before interest and tax divided by investment into 100. As per this calculation, 4 lakh is our EBIT that is given here. The EBIT is given 4 lakh and the investment is given 30 lakh. So here you see EBIT by investment 4 lakh by 30 lakh into 100, that is 13.33%. This 13.33% is more than 10%. What is 10%? 10% is the interest on the debt. So that means interest paid on debt is less than the return on investment, and that is why this is happening, that as we increase the debt funding, the earning per share for shareholders is increasing. Now let us see another situation of company Y. You will see here that the return on everything else is same, only here the EBIT has been changed, that is it is 2 lakh. Instead of 4 lakh, the EBIT is 2 lakh. Okay, so here the calculation will be EBIT is 2 lakh, investment still is 30 lakh. It is multiplied by 100, we get 6.67%. Now 6.67% is less than 10%. Less than 10% means the 10% was the interest on debt. So if this is the situation, what will happen? Again, is it going to earning per share, is it going to increase as we increase debt? Let us see. See here in situation 1, interest is nil, as because in the first situation we have not used any debt. The earning before tax will be 2 lakh only. The earning after tax will calculate 30% on 2 lakh, so it is 60,000. Earning after tax will be 2 lakh minus 60,000, that is 1,40,000. Number of shares were 3 lakh. and earning per share 1,40,000 divided by 3 lakh, that is 0.47. In situation 2, we have used 10 lakh from the debt. Here the 2 lakh is EBIT, interest is 1 lakh. Why? Because we have used 10 lakh as the debt. Now 1 lakh will be the earning before tax, that is 2 lakh minus 1 lakh is 1 lakh. Now calculation of tax will be on this 30% of the earning before tax. So we will get 70,000 as the earning after tax. Earning after tax is this much, because we have deducted or we have subtracted 30,000 from 1 lakh. That was the earning before tax. Then number of shares here is 2 lakh, because 1 lakh 10 lakh we have taken debt. So 20 lakh is the equity. So 2 lakh of 10 rupees each. Earning per share here is 0.35. Here it is even less. That means it has become nil, because here we have used 20 lakh for debt. So here we see that earning per share has gone low. So in this situation we see that this use of debt will not be helpful. It is costly, it is risky, it is not going to reduce the cost. So this phenomena where we are increasing the profit earned by equity shareholders due to presence of fixed financial charges like debts or interest, that is known as trading on equity. And the financial leverage is what? That means the financial leverage increases the cost. As the financial leverage increases, that means as we increase the use of debt in the total funds, the cost of fund declines. Overall cost of fund declines because of increased use of cheaper debt. Because equity is costly, but debt is not. But the financial risk increases. Okay, thank you.